Hey there, everyone. Welcome to Chart This with Dave Keller. It's Friday, December 13th, and we're coming to you from a kind of overcast, but still quite lovely Redmond, Washington. Hope you're having a great end to your week. A bit of distribution in the major averages. We're recording this a little bit earlier because we are actually heading into Seattle in a short while to do Tuba Christmas. If you've never heard of Tuba Christmas, wherever you live, if you're in the United States, there's probably a local Tuba Christmas event. It is an event for musicians, tuba players, baritone players, euphonium players to go, and you play a bunch of Christmas carols, and it's a free concert usually, and you get people to just get in the holiday spirit. I used to do it back in the day in my college years, and have often wanted to sort of relive that joy of playing an instrument. I actually studied trumpet in college, but I do happen to have some low brass instruments around, so I'll be taking the euphonium in, taking the family in, and playing some Christmas carols tonight. But anyways, that's why we're doing the show not live, but a little earlier in the day. You know, the week overall has been in a period of distribution. This week in particular has been noticeably so. So we've had a lot of great questions through the course of this week based on our normal show. As a reminder, I can see all those questions that you put in as comments on whatever platform you're streaming on, or certainly if you're watching the replays on our YouTube channel. And love to dig in a little deeper to some of those great questions here on our Friday episode. Let's get to question number one. Dave, when you are refining indicators for intraday or daily timeframes, how can you determine an effective period? Really interesting question. I thank you for starting us off with a good one. So here's what I would say, right? When you're using technical indicators, I would say it's the same answer for me. Same general answer would be related to what period you should use for the chart, right? Should I use a daily chart or a weekly chart or a monthly chart or a 15-minute chart or something like that? The types of charts, the periods of the charts, the types of indicators, and the periodicity of the indicators should be defined by your investment goals, right? So if you're a swing trader and you're trying to play the next couple days, if you're a position trader trying to position for the next couple months, if you're a day trader swinging for the next couple minutes, that answer is the first answer you want to figure out, right? And again, not that any one of those timeframes or approaches is right or wrong. I've found for me, sort of being on that medium term or long term time frame kind of fits with my personality and the time and energy I want to dedicate to this investment process and what I think makes sense. But you might have very different answers. So I can't tell you here's the right one to use. It really is sort of your own. And I'm just realizing I'm not actually showing you my screen. So let's get there. There we go. So, looking at a chart like IBM, I think for me, I use indicators in periods that have helped me be on the right side of markets that I want to be in, right? And so I would say, what you can do is start with a certain setting, but particularly early on as you're kind of refining your approach, you want to be a little more nimble with it. And here's an example, right? As a medium-term investor, meaning I'm looking for like the next month or two, which for me is kind of that medium-term time frame, the 14-day RSI on a 2-year daily chart works really well for me. That time frame helps me understand where the stock has come from. The moving averages that I'm using, the RSI, using a 14-day RSI fits pretty well. And I'm able to identify divergences, identify pullbacks and potential entry points. I feel like I have a pretty good sense of it. Now, as I'm going, if things were not going as well, I would probably start dialing this period down to like a 9-day or even a 5-day. And if I was a swing trader, I'd probably be looking at like a 3-month chart or 6-month chart with a 5-period RSI, because I'd just be trying to identify some of those short-term swings, right? So, again, I think the right answer for you is going to be defined more by, your goals, right? So looking at like a 5-minute chart, then I can start to see some of these pops where we're trading very higher and then coming out of that overbought region. And maybe that helps me identify some of the short-term swings on a chart like this. If I'm shorter term, maybe I'm paying more attention to candle patterns and divergences than I would, or reversal patterns than I would as a longer term investor. So I don't know if there's a right or wrong answer to any of these. I would say most indicators kind of have a default setting, like the 14-day RSI, like the MACD indicator, 12 and 26, and then a 9-day signal. those are kind of the default settings for sort of like an average use case. But I wouldn't, not be afraid to make those periods shorter or longer. And, depending on what you're doing. And I think the two levers you can kind of pull, number one, what type of chart am I looking at? So if you feel like the signals are too noisy, maybe go from a daily chart to a weekly chart. Maybe you don't have to mess with the indicator too much. You just need a longer period of time. So the right answer kind of comes over time. And I feel like if you talk to people, like me, who have been doing this a while, the default chart that we use is something we've arrived at. It's not something I started with and I just kind of knew this. I actually use a totally different chart 24 years ago as I was just learning this stuff. But over time, I started to realize, okay, that signal is way too early. I need to look at bigger time frames. Okay, that indicator is not sensitive enough, so I would change it. And by tweaking things, by using more of what works and using less of what does not work, that's how you arrive at sort of your default chart that kind of fits with your particular approach and what questions you are trying to answer as a trader or as an investor. Boy, that was a long-winded question, long-winded answer to your really good question. I hope I'm not that verbose. Sorry, I'm getting a slow start here on a Friday. All right, question number 2. I hear a lot of people like Tom, and you're talking about Tom Bowley, my podcast interview last week with Tom, saying interest rates are expected to fall in 2025, but the expectation for rising rates, which is an ETF, ticker EQRR, keeps rising. How do you explain that? Yeah, so if rates are supposed to fall, how come the stocks that, are doing, the expectation for rising rates ETF keeps going up? Here's the ETF that you're talking about, and I do know this one because I've looked at it before. This is an ETF by ProShares, where they're basically identifying stocks, and here's the answer to your question is right here, that tend to do well when rates are going up. So what you have to remember is there's a general kind of thinking, right? If interest rates go up, what stocks tend to do well? If interest rates are going down, what stocks tend to do well? And so an ETF like this is just giving you a group of things that tend to do well when rates are going up. Now, there's no guarantee that they're going to do well in this particular moment, in this particular cycle. I tend to think of things like rising rates and falling rates not as absolutes, right? Not as guarantees, but more as headwinds and tailwinds. They're more tendencies, right? So when rates go up, certain things tend to do better, like financials or, really like energy, like cyclical companies, because rates going higher usually means that the economy is in good shape and there's expectations of future growth. And so that means things that kind of do well, that are economically sensitive, will probably do pretty well. And those are kind of cyclical sectors. When rates are going down, that means the opposite. So there are things that tend to do better when rates are going down, but there's no guarantee that that's what's going to happen right about now. So I would say with something like the rising rates ETF, I would be looking somewhere where you can find holdings. So I'm using Koifin. This is what I use for this, but there are a couple of websites you can look for and figure it out. But I would argue, as part of your due diligence when you're looking at an ETF, look at the companies that are being held, the sector distributions. What sector bet are you making when you're buying this ETF? How many holdings? What the concentration is? You look at the percent of the ETF's holdings that are in the top 10 stocks, which gives you an idea of, is it super top heavy, super concentrated, or is it more equal weighted? All of those things, fees, et cetera, risks, all should be part of that normal due diligence process, I would argue. So when you look at this, 9 of the top 10 holdings are in energy, and energy makes up about 29% of the ETF. So you own a bunch of energy stocks with EQRR right now. And second is financials. That's the two sectors we mentioned that kind of tend to do well, so I'm not surprised. And after that, it's consumer staples, materials, consumer discretionary. I can see that in the sector breakdown here. So basically the EQRR, you're making a big energy bet right now. And so kind of makes sense that when rates are going up, that means probably inflation is increasing. And that means prices are going up. And that means oil prices are going up. And that means these stocks are probably going to do pretty well. If you listen to my conversation with Tom, I'm pretty sure we didn't talk about energy, because energy has not come up with many of my guests because the charts have not been very good compared to others. So I would say he would probably tell you, we talked about other sectors that could do that would most likely do well given the interest rate environment going forward. And his comment was rates are coming down, but you also have to remember the other point is the long end of the curve versus the short end of the curve. We talk about the Fed lowering rates; they're lowering the lower end of the curve, the short end of the curve, not the long end of the curve, which is more driven by free market forces. So that's another kind of part to this story as well. So that's a long-winded way of saying I would look at the holdings with something like this. It's actually a pretty concentrated sector bet that you would be making, and that may be fine with you, but I would be aware of that particular type of thing. And so the reason why the ETF is going up or down is based on the stocks that it holds. And if you look, it has a basket of things that tend to do well if rates are going up. This ETF could do quite well even if rates go lower, because it's not the only thing to think about, right? Rates are just one factor among many. All right, next question. In terms of the base rule that you mentioned, if a base is 20% deep, for example, then one could expect a 40% move up, so double the depth. This question came from earlier in the week. I don't remember what chart we were actually talking about. But the chart of NVIDIA comes to mind, so that's what I'm going to use. NVIDIA is in a basing pattern. There are a number of things that sort of in that sideways basing pattern. Might have been from like Bitcoin or something. I forget what we were talking about when this question came in, and I apologize. I didn't remember that. And maybe I misspoke, or maybe I didn't make it very clear. So let me clarify. When you have a basing pattern is anywhere it's kind of like a rectangle on the chart, right? Where there's a chart can be going up. Higher highs and higher lows. It can be going down, lower lows and lower highs. It can be going sideways, which means kind of static highs and static lows, right? A consolidation or an equilibrium phase, right? And so the chart of NVIDIA, you can draw a rectangle around the recent price action over the last 6 weeks. That's sort of a basing pattern. So when you break out of the basing pattern, you can use the height of the pattern to anticipate an objective. So in this case, you would take the height of the pattern and then project it down. So what I would literally do, using this as an example, is say, okay, if this is and sorry, I'm kind of drawing an arrow. Yeah, so like if this is the height of the pattern from like here to here, right? And then we would make then what I would say is, okay, and then if we do break down, I would make a parallel move to the downside, right? So I'm basically saying the height, and I did this quickly and sorry, very poorly, but basically take the height of this basing pattern, and if you break down, it's actually 100% of the height would be subtracted from the low, or if we break out, you would take the height of the pattern and then project an equal distance higher. The idea is the height of the base is sort of added to a breakout or subtracted from a breakdown. It's not double as you indicated in your question. You sort of anticipate an equal height of the pattern sort of added to the breakout level or subtracted from the breakdown level. That is a basic approach. And again, I will tell you, with any sort of price objective or price target, I mean, if there's one thing I've learned, it's not to just take profits or unwind positions because you reach a price target. Follow the trend and let the chart tell you whether you should stick with that trend or if the bottom or top may be actually happening. Great questions so far. We got 3 more to share with you, but I did want to let you know here to take a moment and say our last free webcast of 2024 is coming up next week on Tuesday, December 17th, 1 p.m. Eastern, 10 a.m. Pacific. I will be doing an exercise that I do every year, and I will be doing it on a live webcast for all of you to enjoy it with me. It's called Trading Reflections, 10 Questions Mindful Investors Ask at Year-End. This is an exercise I've done for years. At the end of the year, sort of look back and think critically about what went well, what went poorly, what I did great, what I missed, what I could do better, and just sort of take stock of how things are going after the year, and then start to sketch out a plan for improving my processes in the year to come. And I'll share with you the 10 questions. I will provide those 10 questions in a beautiful printable PDF format for you to answer the 10 questions on your own as well. But I will actually unveil the 10 questions and share with you my own answers. And I hope it just helps you think about the markets, think about your year, and hopefully set you up for success. You can sign up for that free event at marketmisbehavior/reflections, or just click on the link in the description below, scan the QR code that you see over my blue shirt on the image. Any of those options will get you there, marketmisbehavior.com/reflections. I hope I will see you at that free webcast coming up next week. All right, next question, Dave. When looking at divergences between price and RSI or CMF, the Chaikin Money Flow, what time frame do you find most useful? That's a really good question. I would go back to probably my first question today from about what periods you use. I think at the end of the day, it's a bit of trial and error. I can give you sort of a suggested starting point, but I do think of those as a starting point. I think you have to kind of evolve them from there in your own process. When I'm thinking of something like RSI or Chaikin Money Flow, I use a 14-day RSI with Chaikin Money Flow. I do a 20 or a 21-day Chaikin Money Flow looking at the last month. The reason why I use those is Wells Wilder, when he designed RSI in his original writings, 14-day was what he came up with a bunch of his own back tests on what worked. Now, granted, a lot of that work was done using commodities through the 1970s. So, how applicable is that to today? Well, I would say my use of the indicator tells me it's still pretty relevant because it still works for me. With Chaikin Money Flow, the idea was look back at the last month. So that's why he used 20 or 21 days as a look back period. I would, if I were you, if you're trying to answer that question for yourself, I would start with those timeframes and then tweak them from there, right? Start with sort of the default. And then if you find it's not giving you enough signals, you make it a shorter time frame or a shorter period. If it's giving you too much, then you make it longer. For me, in terms of the charts that I use, the 2-year daily chart, that is sort of my default chart. Anytime I bring anything up on the show is really the first chart I look at for anything. And then I tend to look a little longer term and a little shorter term, depending on what I'm trying to do, right? So if someone asked me, give a technical analysis overview of Johnson & Johnson, I would start with the 2-year daily chart, look at like a 5 or 7 year weekly chart, and then probably look at a 6-month daily chart or an hourly chart using candlestick analysis, and just try to understand some of the short-term time frame. And using the 3 of those together, I would make sense of it. With divergences, for me, the main divergences are on the daily time frame using the 14-day RSI. That's kind of the classic divergence that I look at. Because I find more often than not, it gives me great signals like March of 2023 on Johnson & Johnson telling me we're probably hitting some sort of bottoming point. That period works pretty well, and I've had success with it. And so that's what I would default to. I would start there. And again, if it's think about what signals you're getting and what results, and then tweak it from there. And, having worked with a lot of different technical analysts, we all have different default charts and settings and indicators. And it really comes from our own experiences, what mentors we had and what techniques they used and recommended, what books we've read that sort of in our formative years, what markets we initially traded. I found that sometimes will affect what tools and processes we used. I would encourage you to embark on your own journey of discovery and answer that question yourself. Thanks for asking about that. Next question, with accumulation days and distribution days, is there any criteria they must meet to be classified as one of those days? Or is it more of a general theme? IBD, Investors Business Daily, says 3 to 4 distribution days within a 2-week period should be a concern. Yeah, thanks for asking about that. It's probably a language thing or a vernacular thing. IBD and others have specific criteria for like a distribution day, right? So if you're looking at, if you read any of their content, they actually have specific things. So it's, if there's a down day with, X% above normal volume, and I don't remember the exact threshold for the distribution days. I apologize. I should know that, but I don't remember at the moment. But they actually have a very specific criteria that Bill O'Neill came up with years and years ago, which would designate an official distribution day. And they say if you have X number of distribution days or X period of time, that has meaning. I tend to use words like accumulation, distribution as general descriptors of price action that I'm seeing. So a big down day is a distribution day, and a big up day is an accumulation day. And particularly within an uptrend, when you have a big distribution day, that is a down day, meaning we close near the lows of the day, or it's down from yesterday's close on heavier volume than normal. For me, that's a distribution day because the direction of the price tells you that there's more selling than buying going on. The increase in volume tells you that it is, more larger positions that are being moved. And so that probably tells you something. So I'm not as much of a hard and fast. It needs to hit a certain threshold over a certain period of time, and then it's a thing. But as IBD really, I think, does a great job of sort of sticking to that sort of set of rules. For me, it's more general observations, and recognizing that there's a distribution day just says a big down day on heavier than normal volume. That's kind of how I think of it. I don't really measure much. It's by the end of the day, I can kind of tell you, yep, this was a distribution day based on, I guess, my own assessment of the trends in the volume through the course of the day. There you go. All right, last question for today's episode. And thank you again, always, as a reminder, all of these questions came from viewers like you over the last week. Please keep them coming. As you're watching the live stream, pop a question in the comments section. If you're watching my show on the replays on YouTube, just put a comment with questions that you have. And I would love to continue to bring some of your great questions and consider them for all of us to benefit. Final question here of the week. The S&P daily relative strength is fine, but the weekly relative strength definitely shows a divergence. Does that concern you, or is that a concern for down the road? I love that. I love the end of your question. Does that concern you, or is that a concern for down the road? Yeah. So here's the thinking, right? So on the daily chart, and I remember making this point, might have been yesterday or the day before, that there's really no bearish divergences right now, right? If you look from the August low, look at this peak, this peak, this peak, this peak, and then the most recent peak, and just look at the RSI, and it's literally getting a little bit higher every time. So that is a chart going hot, going stronger, going higher on stronger momentum. Now you compare that to the IWM, which someone had actually mentioned in the questions, and you see a bearish momentum divergence, right? A clear higher high early November to late November on weaker momentum, right? So there's that divergence clearly there, but you're not seeing the divergence on the daily S&P chart. Now on the weekly S&P chart, you are definitely seeing a divergence here. So does that concern me? For sure, right? I mean, yeah, definitely. And I would say that divergences can be on different time frames. I think they could mean different things. If you look back at late 21, we had a clear bearish divergence there. In early 2020, we had that bearish divergence here. On the daily charts, those were pretty clear bearish divergences as well. But not all of those kind of continue, right? I mean, if you look, the real bearish divergence here was July to kind of October, when we're making new highs on weaker momentum. So there's been a bearish divergence now for kind of 3 months. So the problem I have with betting too much on the weekly divergences is they can persist for quite some time. An example of that is, like, look at mid 21 to late 21 and look at the MACD or the PPO indicator, which was literally sloping downwards that entire time. So what I found with weekly divergences, particularly in a protracted advance, and again, 2024 and 2021, very similar in a lot of ways, we saw a big divergence there also, right? From sort of April to July, and the price keeps going higher. So for me, on the weekly RSI or weekly PPO, given the nature of how long uptrends can last, I've not found it to be as meaningful, and it just takes months and months and months for there to finally be a signal. So could you argue those divergences were eventually confirmed by that breakdown in early 2022? I mean, maybe. But that's why I'm not too concerned about a divergence here. That just tells me we're going up a lot, and at some point we're probably going to get a top. But as a timing tool, I've not found it to be particularly valuable. The daily divergences tends to be a little more time sensitive, right? So if you have higher highs on weaker momentum on the daily chart, that could mean a short-term pullback, and so it's more timely, it's more actionable, and more relevant to the short term. So that's how I think of them, I guess, in different timeframes. Again, the weekly charts, if you look at a lot of things, particularly things like stocks, which have been in general uptrends, you'll get weekly divergences that just don't. It takes so long for those divergences to actually be resolved. There's not much signal there, right? I mean, if you get a divergence, then 4 months later it's completed. I don't know if that really helps you for that 4 months to be waiting and waiting and waiting and waiting. But the daily ones tend to be more, I guess. What's the word? Time sensitive or timely. That's it, folks, for today. Thank you guys so much for all these great questions. And again, they came from viewers like you just asking things. And I appreciate all of the questions you guys have continued to ask. It makes what I do a lot of fun. Helps me to shape the content and really focus on some of the questions you guys are literally trying to answer. So keep them coming. But between now and next week, I hope you have a fantastic weekend. Enjoy, and best wishes, of course, this holiday season as we're preparing and doing fun stuff on the side. If you're in the Seattle area, check out Tuba Christmas tonight. I think it's 6 p.m. Pacific time at the Armory right in Seattle Center. So hope to see you there. For Market Misbehavior, I'm Dave Keller. Have a great weekend. We'll see you next week. Remember, it's always a good time to own good charts.